What's up, guys? It's Cashflow Cart back with another video. So today should be Monday. On Thursday, I had a video come out and I did the portfolio update. I've made a commitment to do that every month just so you guys can see, I'm really in this game. I'm adding into my positions every month. Um, just kind of show you my process of building the portfolio. So in Thursday's video, we went over the number of shares and estimated annual income, as well as market value of each position. And I also just offered a little bit of commentary on the portfolio as a whole. So I said I would go through kind of the technicals and the outlook for this upcoming year. And that's what we're going to do today. So in this video, we're just going to look at charts. And I also saw this morning, my dad was watching, stock market news and analysis on TV. And every time I watch that, I don't even know if it's productive for a lot of people just because they're kind of always changing the narrative. They're always saying, what's going to happen in the market. And they might offer some like helpful tidbits. I can't believe I just said tidbits. They might offer some helpful insights about the market, but the approach I like to take rather than trying to guess what the market's going to do as a whole is I like to be opportunistic with my capital. I like to find undervaluation in individual names. And sometimes one way to do that is to go through your positions, look at your cost basis, and, just kind of get an idea of what the chart looks like. Okay, this does not always have to be rocket science. You should be reviewing your portfolio in detail. So let's get into it. We'll go through the cost basis, the profit loss open, and I will give kind of my plan for the upcoming year, 2024. I'm super excited. Let's get into it. So starting off, if you guys saw my video on Thursday, Apple is my number 2 position. So here we have the weekly chart for Apple. You can see I've been building this one out for quite some time now. I think the original shares were purchased in 2019, but I've been building this position out for a while, and we saw some dips in 2022. I didn't add any shares in 2023, and I'm probably going to stay kind of in the same boat as Apple's near, these all-time highs, kind of the levels it's at now. We see here the 200-week moving average. That's this green line. It's currently at 143.58 compared to, Apple's share price trading in the 190s. So in 2024, if we see Apple kind of pull back towards this 200-week moving average, maybe that's when I'd get interested in the position again. However, with an average price of 117 on this one, and I've already got 63 shares built out, I'm not really in any sort of rush to add to this one, if that makes sense. So it's definitely not a priority, but I'm holding it. I'm very happy with my cost basis, and I'm excited to see, what Apple's able to do with their dividend in the coming years. Moving on. Coca-Cola. I mentioned this was one of my small positions. You'll see here this red ribbon, minus 31 shares. So at one point I had Coke built into a 31 share position. Unfortunately I took some of those shares off, or I took all that position off in 2021. Hindsight, guys, we're going to make mistakes. I probably should have kept this position on, continue to enjoy that dividend growth, and continue to enjoy, this was probably a $44 or $45 cost basis. So that would have been awesome. So now I've got this rebuilt into a 7 share position, average price of $56. I guess I'm up $15 total, but I do want to build this one out just because as a business, I love Coke. I love the global diversification. I love the width of their economic moat and, the share buybacks. I love their um lost my train of thought. I love their goal of rewarding shareholders through buybacks and dividend growth. It's it's a great one to be a part of. With that being said, guys, I don't want to overpay for a name. I don't want to overpay for a name just because I love the company, okay? We still, as dividend investors, we still have to find value. We have to put our dollars and our reinvested dividends into, our best ideas, our best opportunities. So, we've gone over a watch list on this channel, but kind of same thing here. I'm looking to build out this position, but I'm in no rush. Theoretically, I would like it to dip again, come back towards this long-term support, or even break below it. You see this shaded area here. I'd like to get it in the 40s, but again, we'll wait and see. Right now, I'm just kind of nibbling, picking up shares in Coke, and with time, it'll become at least a medium position in the portfolio. Next up, guys, we got Altria. I know this is a controversial one. In my last video, I talked about how with the stock's total return, that's going to be share price appreciation as well as that dividend yield. And, historically, we've seen the market return about 9 to 10% annually to shareholders. With Altria, you're getting that total return all from the dividend. So with this one, any share price appreciation is going to be, I've said it before, it's going to be the icing on the cake per se. So, I really like where this one's at. I think a lot of fears and negative sentiment kind of hold this one down. But with that being said, I don't want to get too concentrated in it. Although it's not my largest position or even second, I will say it makes up, I'll say probably 40% of my estimated annual income. So again, we've talked about that before, but being a dividend investor, it's not only important to keep track of, okay, what's my allocation like? To me, that's less important. It's more important to say, what's my allocation in my estimated annual income? Does that make sense? Because in this game, we're so income oriented and so driven, in that sense, that it's easy to get carried away with, putting too many of your eggs in one basket. I feel like I'm rambling a little bit on this. I just, I want you guys to understand that there's not some magic number where you need to have like no more than 8% in one stock or whatever people have said before. But a bigger risk is if a big chunk of your income is coming from the same stock. That's where, dividend investors can get into trouble. Yeah, so I'll continue to add, especially if this one falls under 40. But again, it'll be kind of nibbling because I've got this, I've got this one pretty built out. So we'll see. I've also drawn this wedge pattern on the long term from the high of 78 back in, oh my goodness, it's hard to read, is that 2017 was the high of 78. We've seen kind of this wedge pattern. So if Altria breaks to the upside, I'll probably cease buying on it completely. If it breaks down or continues to consolidate in this wedge, I'm going to pick up a few more shares. Moving on, Microsoft. And you guys can see here, this is a pretty similar story to Apple. Built this position out since 2019 or 2020. I was paying a fairly high PE at the time, but Microsoft's free cash flow growth and margins have been so impressive that I thought it was very warranted. Okay. And then I let off the gas a little bit in 2021 when it was having this huge bull run. We saw it pull back to that 200 week, and I doubled down the position with 10 shares, bringing myself to 20 shares at a cost basis of $243. So, same kind of thing here. This one's running up towards all time highs. I've got the position pretty well built out, but, depending on what happens in this tech sector that's been ripping in 2023, if we see, Microsoft, Apple, if we see those kind of names cool off, maybe I'll be able to build it out a little more. We'll just have to wait and see, guys. So I guess I'd be interested if Microsoft fell back towards my cost basis of 243 or even towards this 200 week moving average of 267. But again, with this one, I've got the position built out into, a medium sized position. I'm in no rush to continue building it. We'll move on. Realty income. And I don't want to say I've complained about this one a lot, but this one's been tough. There's been a lot of negative sentiment around it. I fully trust this one. I love their commitment to shareholders. They've coined the term the monthly dividend company. And I think a lot of the negative sentiment in the previous year, 2023, I think that's come from scale. Okay. So size and scale of realty income. Let's try to put this in plainer terms. When a REIT is a really early cycle or a really early stage of growth, they can be very, very focused on kind of their niche. They can be very focused on, okay, we do best with these type of properties. For them, it's retail, consumer staple type stores. And now that we've seen realty income kind of get to the size it's at, they've had to go after some global diversification. They've gone after some spaces in the gaming sector, some spaces in Vegas. So they have kind of moved away from kind of their niche that gave them their initial, strength in the REIT market. But that doesn't scare me at all. They've had a long history of great managers, a long history of rewarding shareholders. I think it was kind of confusing for some investors in 2023 to see interest rates so high, but to also see realty income kind of aggressively making acquisitions. So, it's not a super easy one to understand. I've done a lot of due diligence on it, and I think this is a good time to say, guys, do your own due diligence. This is not financial advice. I'm sharing my journey. But let's check out the cost basis, sitting right above 65 a share with 214 shares, whereas realty income is currently trading at 57. We saw the 2023 low was on this candle here in late October. The low was $45.04. So, there's been opportunities. If we see more dips like this or we see a downtrend in the coming year, I'll continue to build this position. But, as of now, this is actually my biggest position with this little recent rally. It overtook Apple, which is kind of interesting. Let's move on. Pfizer, guys. This one's been, I don't know if any of you guys have been buying Pfizer, but, definitely some risk here. We've seen some falling earnings. And at first it was like, okay, it makes sense why Pfizer's earnings are falling and why guidance is, being scaled back. It's because COVID didn't really have, the lasting impression that I guess investors were pricing it to have in, the 2021 bull run in Pfizer. So it's basically falled from those highs. There's been some other stuff, but not to try to pitch you guys on this one, but I will say a general observation I've made. And, you know, in the healthcare industry, in the healthcare sector, oftentimes individual stocks are way underpriced in reaction to like any sort of negative news. However, in most cases, these healthcare giants typically are fine in the end. And, I know this is a high level conversation, but I'd say healthcare is one of the sectors that is most prone to overreaction on the bear side, whereas something like tech is going to be most prone to overreaction on the bull side. Does that make sense? So we'll look at something like AbbVie, and this is actually one I kind of fumbled on. I mean, it was a good position trade for that reason, but definitely could have built this one out to be a bigger position in 2019 when I was adding it at 77, 65, few shares at 65, 66, one more at 91. And then for some unknown reason, I started unloading it in the hundreds back at previous highs. I think this was a product of like lack of experience and maybe some greediness. But again, what do we see with AbbVie? All this, negative news. This was actually when the Humira, when their patent was expiring, investors were running for the hills from this one. Okay. And this pattern here on this other healthcare giant, it's very similar to what Pfizer looks like now. So for me, I'm in Pfizer. I'd like to pick up a few more shares, but I don't want to get carried away. Again, this is not financial advice, guys. I'm just kind of walking you through my mindset. Let's check out the cost basis on this one because it is not the prettiest. 36 a share. Ideally I can bring that down to lower 30s, but we'll just have to see if it keeps falling, if it finds support here at the 28 level and kind of consolidates, or if it reverses. Again, we're being opportunistic. I'm not trying to make here predictions about the broader market. I'm not trying to say what's going to happen about the broader market, but we're just trying to be very opportunistic and basically build out positions at what we deem to be, one of the best opportunities within a 5-year period. So I see that in Pfizer. I might not be perfectly accurate or, perfectly timed with some of these entries, but that's the part of this game, guys, is keeping your conviction, and being willing. I hate this thumbs up thing. Being willing to kind of build out some positions. We'll move on. Okay, the trades aren't showing up on this one. Hang on. This is Starbucks. We will see if I can get the trades to pull up. Here we go. I guess there's only two entries on this one, and it's really just one entry. It was more of a lump sum type of investment, but my cost basis on it is just over $82 a share. Now it's trading at 96. Again, this one's a free cash flow beast. It is a coffee company with a wide economic moat, which is a little mind-blowing to some of us, but the culture they've created around Starbucks, is something I didn't know we would ever see in a coffee company. But, they've done it. For me, if it does fall in 2024 back towards my original cost basis or even lower, I would be interested in picking up some shares just because they've been, an aggressive dividend grower. However, I'm kind of indifferent to even if I want to build this one much bigger, just because I think a company like Starbucks, there is a level of social risk that comes with it. So I really like this one and I'm really proud of my position, but we'll see. I do think if Starbucks falls much lower, that's probably going to reflect a lot of other opportunities in the market. And so, with that being said, I don't know if it'll be like the most opportune, buy for me. We'll have to wait and see. But as of now, I'm comfortable with my Starbucks position, 62 shares at 82 a share. We'll take that. Moving on, and this is the last position. Very similar to Coke here in the sense that I've just recently, within the past, if I could zoom in a little bit, just made my first purchases of T. Rowe Price in early October, and I've picked up a few more shares here and there. I only have 7 right now at an average price of 100 even. I guess I'm up 50 on the position, but again, I'm not trying to position trade so much as build, an income stream. So with this one, and I actually talked about it a little bit in my 2024 watch list. This one is one I'm really excited about. Okay, a lot of free cash flow, a very sticky business due to, people who hold their money with like an asset management group that, manages retirees accounts, 401ks, target retirement funds. It's difficult, not that it's difficult, it's it's a pain in the butt to move your retirement dollars. There's fees associated with it. And to be quite honest, the average American doesn't want to have to think about, okay, their 401k. They don't want to check it all the time. So generally, they're going to leave their money with T. Rowe. With that being said, though, we won't get some steady level of free cash flow growth with T. Rowe because so much of that is going to be dependent on, okay, when are people retiring? Okay, what's the population in different age groups? Okay, when's the next generation retiring? So it's not going to be some perfect, okay, wow, look at this uptrend in free cash flow, perfect uptrend in net income. It's never going to be one of those. However, if you can kind of identify that it is able to pay a sustainable growing dividend year after year, and generally over longer periods of time, that free cash flow and that net income, they're moving in the right direction, generally, then I think this could be a pretty good opportunity for you. I will say, and I've been a little not nervous, but I'd say this is definitely a risk that we couldn't necessarily identify from, fundamental metrics. One risk with T. Rowe is, if stuff hits the fan in the economy and we have some sort of like huge financial scare and everyone wants all their money out of T. Rowe, everyone wants cash, that would be a situation that could, very negatively affect T. Rowe. If that's the case, though, guys, I think there would be other worries. I mean, I like this one a lot, but any sort of real economic recession, I think would hit T. Rowe pretty hard. With that being said, I'm going to be building out the position next year. Between 80 and 120 is my goal. I'd love to keep my cost basis around the 100 level or even lower, but, we'll have to see what the market gives us. And with that being said, guys, I just want to reemphasize the purpose of this video was, rather than trying to think all the time, stress yourself out, what's going to happen in the broader market? What's the Fed doing? When are interest rates going to really come down? When is inflation going to get back towards that 2 to 2.5% level? Rather than trying to juggle a million things in your head, guys, the best thing you can do as a dividend investor is going to be to stay the course, okay? It's going to be keep putting dollars and reinvested dividends in your best opportunities, guys. Undervalued stock. We've talked about it again and again on this channel. Different valuation metrics, different ways of determining undervaluation. I thought today's video was kind of fun just to have, a very conversational type of day, look through charts, offer some commentary. I'm not some big league dude on whatever CNBC, but I can look at my charts and I can kind of tell you guys where my head's at with each position. And if you enjoy this type of content or even more in-depth content about dividend investing, please feel free to subscribe. If you're already subscribed, I can't thank you enough. It's been awesome. The support in 2023 was amazing. A lot of positive comments, a lot of positive feedback, both from subscribers or people that know me in real life. Um, it's really been amazing. 2024, though, we're taking the content up a level, and consistency is going to be there. It's going to be awesome, guys. Thank you so much. I'll quit rambling now, though.